how student loans affect home buying in today's real estate market. For millions of Americans, student loan payments are as routine as utilities or car insurance. But when it comes time to buy a home, that monthly obligation can carry far greater consequences. In today's housing market, where affordability is already under pressure, student debt has become a defining factor in who qualifies, how much they can borrow, and when they can realistically enter the market. In Florida, and particularly in Pinellas County, the intersection of student loans and rising housing costs is shaping buyer behavior in noticeable ways. Younger professionals are remaining renters longer, co-borrowing with partners or family members, or targeting lower price points to accommodate debt-to-income constraints. Understanding how student loans influence mortgage approval is essential for buyers and sellers navigating this evolving landscape. The debt-to-income equation. At the center of the issue is the debt-to-income ratio, commonly referred to as DTI. Mortgage lenders calculate DTI by comparing a borrower's monthly debt payments to their gross monthly income. Student loan payments are included in that calculation, even if the borrower is on an income-driven repayment plan. Higher student loan balances can limit purchasing power in two primary ways. First, they may reduce the total loan amount a buyer qualifies for. Second, they can narrow the margin needed to absorb rising property taxes, homeowners insurance, and association fees. In Pinellas County, where insurance premiums and flood coverage costs have increased in recent years, the additional financial strain can compound qualification challenges for borrowers already managing education debt. Deferred loans and income-based repayment plans. Many buyers assume that if their student loans are deferred or on an income-based plan with a low payment, those obligations will not affect mortgage approval. In practice, lenders must still account for them. If no monthly payment appears on a credit report, lenders often apply a calculated percentage of the outstanding loan balance when determining DTI. Even a modest imputed payment can alter eligibility thresholds. Borrowers enrolled in income-driven repayment programs may benefit from lower qualifying payments, but lenders verify documentation carefully. Consistency and clarity in records are critical. Credit scores and long-term impact. Student loans also influence credit scores, which in turn affect mortgage interest rates. A history of on-time payments can strengthen a borrower's profile. Missed payments, delinquencies, or default can have the opposite effect, sometimes requiring years of recovery before a competitive mortgage rate becomes attainable. In competitive housing markets such as St. Petersburg and Clearwater, where multiple offer scenarios still occur in certain price segments, buyers with stronger credit profiles may have an edge when sellers evaluate financing reliability. Delayed homeownership trends. Nationally, economists have linked rising student debt levels to delayed first-time homeownership. The pattern is visible locally as well. In Pinellas County, many younger buyers enter the market later than previous generations, often after stabilizing their careers or reducing loan balances. This delay can reshape life decisions from family planning to geographic mobility. It also shifts demand toward entry-level homes, townhouses, and condominiums where monthly carrying costs align more comfortably with existing debt obligations. Strategies buyers are using. Despite these challenges, student loans do not automatically disqualify a buyer from homeownership. Many borrowers successfully purchase homes each year. Some strategies include reducing other debts to improve overall DTI, exploring loan programs with flexible underwriting guidelines, applying with a co-borrower to strengthen income qualifications, seeking properties with lower insurance and tax burdens. Careful financial planning before entering the market can make a measurable difference. Buyers who review credit reports early and consult with lenders well before making offers often gain a clearer understanding of their purchasing capacity. What sellers should understand. For sellers, awareness of student loan dynamics provides context when reviewing offers. A pre-approval letter reflects more than income alone. It reflects how debt obligations have been evaluated. In markets where affordability margins are thin, financing stability becomes as important as price. Sellers who understand the broader financial pressures affecting younger buyers may better interpret timelines, negotiation flexibility, and contingency requests. A market shaped by education debt. Student loans are now a structural component of the housing economy. They influence not only individual purchasing decisions, but broader market patterns, including demand, timing, and price sensitivity. In regions like Pinellas County, where coastal living carries added insurance considerations, the interaction between education debt and housing costs underscores a simple reality. Affordability is multifaceted. Income, interest rates, insurance premiums, and student loans all converge at the closing table. For buyers, preparation and realistic budgeting are essential. For sellers, understanding the financial framework buyers operate within can foster smoother negotiations. Homeownership remains attainable for many borrowers with student debt, but it requires clarity, discipline, and a clear-eyed assessment of long-term obligations.